Hello everyone, my name is Luka Đurović and I'm coming from Serbia. I'm here at soccer team and I'm a junior studying business analytics, and today I'll talk about relationship between risk and return and how investors decide how much risk they're gonna take. I'll start with the question: uh, how much extra return should investor expect for taking more risk? I would really like to hear this answer from my professor Stefan Đukić. Let's get back to the chapter 7. One of the most important ideas about this chapter was finance. About high returns usually come with higher risk. This means if you want higher risk and high returns, you should usually must accept more uncertainty. For example, if you want very safe investment, you can buy treasury bills, but these investments can go up or down. This leads to an important question: how much return should you expect for the risk you take? And this is what asset pricing models try to explain. One important idea actually in the chapter is the capital allocating line, also called as CAL. The CAL shows all the possible combinations of risk-free asset and a risky portfolio. So if an investor wants less risk, they can invest more money in the risk-free asset. If they want maybe more return, they can invest more also in risky assets. These give investors just flexibility. So, each investor can choose the combination that fits their risk tolerance. Uh, Another important concept is optimal portfolio. This is the best portfolio for investors based on their risk preferences. Some of investors are more conservative, other are maybe more aggressive. Um, that's what we talk about capital market line, which is also called CML. The capital market line shows the relationship between risk and return for efficient portfolios. Um, the CML just shows that investors should choose a combination of the risk-free assets and the market portfolio. Um, another, another very important model in chapter 7 was CAPM, which stands for Capital Asset Pricing Model. CNM help us calculate the expected return of an investment. It says that expected return depends on the three things: the risk-free rate, the market return, and the beta. So, beta is very important because it measures how sensitive stock is compared to the market. If beta is one, if beta is one, the stock moves like the market. If beta is above 1, the stock is more risky than the market. If beta is below 1, as we said, the stock is less risky than the market. So CPM says just investors should only be rewarded for systematic risk. Systematic risk, as we said, also is market risk that cannot be diversified away. And I would give also another important concept is that security market line, also called the CML, shows the relationship between beta and expected run. If a stock is above CML, it may be undervalued, but if a stock is below SML, it may be, as it says, overvalued. In this chapter also explain the assumptions of CAPM. Some of these assumptions are the investors are rational, investors want to maximize the return. Investors borrow at risk-free rate, and markets are competitive. Of course, these assumptions are not perfect in real life, but they can help us understand the model. Um, beta beta can be found comparing stock returns to market returns. This is often done using regression analysis. We can also estimate portfolio beta. Portfolio beta is simply weighted average of the betas of the individual investments. Let's say, for example, if half of the portfolio in a stock with beta is 1.2 and a half stock with beta is 0.8, the portfolio beta would be then just 1. However, I mean, estimating beta is not perfect, but beta can change over the time. So companies change, market changes, and economic condition change. Because of this, beta is only an estimate. It's not always, I mean, it cannot be a perfect number. And CAPM helps investors also estimate fair returns on risk. Beta helps measure how risky a stock compare to the market. I mean, in conclusion, it just shows how investors build portfolios, measure risk, and estimated expected returns. I mean, I would say the most important idea to remember this chapter is simple. Higher expected return usually requires high risk, and the diversification helps reduce unnecessary risk. Thank you so much.